All right, let's look at another example. So here I have two individuals. They decided to start a new company that's going to focus on the nutritional and spiritual needs of Pokemon. After weighing the pros and cons of the different business structures, they've decided to set up a company as a corporation. So this tells us we're going to need to use those corporate terms. So instead of owner investment, we're going to use common stock. Instead of drawings or withdrawals, we're going to use dividends. Instead of owner's equity, we'll use stockholders' equity. Okay, so it just kind of clues us into the different terms and titles we're going to be using. All right, so let's go ahead and set up their accounting equation for a corporation. Get a little more room here, hang on. And you can feel free to pause the video and try it yourself and then compare. And let's go ahead and expand the stockholders' equity. Okay, so stockholders' equity, 4 components: common stock, dividends, revenue, and expenses. And I should probably remind us, I think we remember this, that revenues decrease equity, right? We take away revenue or take away expenses from revenue to get net income. Dividends decrease equity, whereas revenue and common stock increase equity. All right, so our first transaction, we have a loan taken out for $15,000. So that means the company got a loan of $15,000. So for assets, I can now include cash as an asset. So for number 1, the company's cash balance increased by $15,000. It's a loan, which means it needs to be repaid to our creditors. Most of the time, if you see the term loan, the liability you can use is note payable. Note payable went up. That balance went up by $15,000. Okay, so we have a positive $15,000 and a positive $15,000. So think of your scales here. You have the same amount on both sides. We are in balance. Just get in the habit of checking after each transaction, right? Okay. The next one. Brock invests $5,000 of his own cash. So the cash account for the company goes up, and he gets common stock in exchange. That's right. Okay, you can see it's a positive $5,000 on both sides. We're still in balance. And don't worry, you will get some practice with this in your homework because we want to make sure you're comfortable with this. All right, your next one. The two meet with their first client and they provide a service, and it has a value of $250. The client is going to pay next month. Now think back to your principle from earlier this chapter. The revenue recognition principle says, if we've provided the service, and we prepared the nutritional intake and we prepared a meal plan, so we've already provided the custom service, this has to get recognized as revenue. So plus $250. Now the offset might be a little hard here. We didn't get cash, right? There's no cash received from the customer. They're going to pay next month. So that's a new asset we were introduced to in chapter 2, accounts receivable. That's when your customer owes you money. So it's a customer account to be received in the near future, usually about 30 days. Okay. So that was kind of an interesting one, but we still balance. We're still good. Let's look at our next transaction. The two owners hold their first nutritional class. They charge $10 per attendee and they accept cash payments only. The first class that's already been held had 15 participants. So assuming they all paid $150 and we provided the service. Revenue recognition says if you provide your service, record that revenue. Okay, and then the company pays their landlord. If it just says pay in the prompt, it doesn't say pay on account, you assume that's cash. So cash went down $100. That's not bad for rent. Okay, and then down $100. Okay, so you have negative 100, both of your sides balance. You have a negative 100 on both sides. The same value has to be on both sides. All right. Well, make sure you have some exercises to try this out. Practice makes progress with this one, as with most things in chapter 3. All right, good luck.